Hi, everybody. Today's presentation is called Business Valuation, Tips, Traps, and Positioning Your Law Practice for Growth. My name is Josh Horn, and I'm excited to be with you today. Today, my only request is that you have some fun with this. I will give you some tips to help your clients and make more money in your practice. So please consider using at least one of these when you return to your office. If you aren't doing this now, after today, please consider looking at your clients' businesses and your practice in terms of business value and the drivers of business value. Finally, please call or email me with any questions about this presentation or anything else you need help with. I'm here to help you, so let me know if you need anything. Here's a little about me. I'm a CPA with 2 business valuation credentials. My experience is in corporate and public accounting. My company provides CFO services as well as valuation and forensic services to attorneys in litigation, family law, and mergers and acquisitions. I'm extremely passionate about business valuation, quantifying value, driving it higher, and helping professionals like you. I'm so passionate that 6 months ago I walked away from a good-paying corporate management position because I think this is my calling. I believe our economy is standing on the edge right now. Growth rates have slipped below long-term averages, and business startups have plummeted. You, the professional attorneys, stand on the front lines with businesses that desperately need your expertise. The success of our economy will depend on whether you and I can help private businesses thrive again. If that sounds heavy, it is. However, there's also tremendous opportunity for attorneys who can be problem solvers for businesses. Business valuation provides an excellent framework for you to be problem solvers for your clients. Let's learn a little about business valuation and grow your practice. What you will learn today: business valuation basics and how you can use basics to help your clients make more money and stay safe. Who should you use to help you with business valuation? Business valuation standards and why should you care? What the business valuation analyst needs from you. A few small changes can move your value 6 figures when your valuation also becomes a forensic assignment. Rules of thumb and the dangers of using them. How do you know you need a business valuation? How much does a business valuation cost? And then wrap up and email me or call me with any questions. What is business valuation? This is a simple definition to get us started and to make sure you are all in the right course. Business valuation is the act or process of determining the value of a business, enterprise, or ownership interest therein. And that's from the NACVA's professional standards in their international glossary of business valuation terms. Just a basic definition to get us started. In the context of today's discussion, business valuation could also mean determining an income source in a damages environment or a fraud case or any way that you're trying to determine an economic income stream of any kind. This is a more specific terminology. I'm going to touch on some of the other ways it could be used as well. I promise only 2 math slides today, and this is number 1. For those of you that hate math, I'm going to show you how to do math in a couple places. I want you to remember this slide as we go forward. The variables are extremely important. They're basic to understanding business valuation. We'll refer back to them as we go. Business Valuation 101. A great teacher showed this basic fraction to a business valuation course I attended many years ago. I'm going to use it to teach you the income approach to business valuation in just a couple minutes of time. Doesn't take long. V equals C divided by R minus G. Value equals cash flow divided by risk minus growth. We're solving for V. V is value, just like we would back in our junior high and high school years. We're solving for V by estimating future cash flows, future risk, and future growth. This is not hocus pocus. The math is simple, but the devil is in the details. What is cash flow in the future on a forward-looking basis? What is future risk? And what is future growth? And what about the many other factors affecting value in your company? Examples include the quality of management, financial strength in the industry of the business you're looking at. Who has evaluated these factors, and do they know what they're doing? The best business valuations are going to be the ones that tell a story supported by facts and assumptions. And the best story will win ultimately, based on solid data as well as some assumptions that go along to tell the story about the business. I want to show you how you can use business valuation, the service itself, and the concepts behind business valuation to make more money, position your practice for future growth, and stay out of trouble. This slide is organized into 4 categories. I found that most valuations fall into one of these 4 broad areas. Instead of viewing this as a laundry list of services, I'd like you to look at this as multiple ways of building your practice, places where you may need to collaborate with other professionals, and places where you may be able to get by on your own. Buying and selling, starting from left to right, estate or gift, which includes the Internal Revenue Service, compliance type valuations, and ouch, which generally means somebody or somebodies are fighting over something. So hopefully most of you recognize different service areas that you're involved in, or your colleagues. Let's kind of go through these, and let me check with some of you that are watching this presentation. Some of you advise businesses. Some of you do M&A work. That's mergers and acquisitions. How many of you do estate, gift, or income tax work? Some of you advise public companies, work on employee stock ownership plans, or do bankruptcy work. Some of you work in litigation. Some of you work in family law. Some of you handle shareholder disputes. And some of you advise on damages, including personal injury or claims against a business for damages. So is it fair to say, I hope, that many of you or your firm members could run into a need for business valuation? Or stated another way, the 2016 Georgetown Law Report on the state of the legal market, which we're going to refer to again later, defines 7 law practice areas: real estate, corporate, tax, litigation, labor or employment, patent litigation, and bankruptcy. There could be a need to utilize valuation or determine an income stream in nearly all those areas in certain circumstances. Now let's refer back to the Business Valuation 101 slide quickly. How are you going to improve practice cash flow? Money. How are you going to get more money into your practice, ideally on a consistent basis? Hey Bob, you just turned 60, right? What are your plans for your business? Let's sit down and talk about options for selling, start to identify some potential buyers, and move toward quantifying business value, tax ramifications, and what retirement might look like. If you're planning on working another 5 years, Bob, let's develop an annual progress plan for those next 5 years. So that would be something you could grab onto underneath your corporate advising, the buying and selling section, something like that. Hey Mary, you haven't updated your buy-sell agreement for 10 years. I noticed you still have Jane on as the buyer in the event of death or disability. You bought her out some time ago. Also, this value clause could use some work. It's based on old language. You've merged 3 times since this was written. Why don't we sit down and revise this agreement, get a current company valuation, and stay on top of this once a year. Notice how we're building some recurring practice building ideas. So these are all practice builder ideas you could take a look at, and they create recurring revenue streams for your practice. Hey Joe, I estimate your net worth could be north of several $1,000,000, and about 90% of that is in your business. Nothing in your estate plan protects you from downside tax risk. You also have no succession plan in place. Let's quantify business value, your total net worth, and develop an action plan for transferring your business. Your son is working in the business, right? Would you like to pursue gifting or selling the shares to him over time? There are even opportunities in litigation. Hey Debbie, I know we just finished the last step in your business litigation case. Do you think it would be a good idea to put some new legal safeguards in place? Then we could review them annually and stay on top of protecting your business. It would be a good idea to stay on top of the value of the business too, for risk management, insurance, and other reasons. If you're doing all these things now, that's fantastic. You're probably ahead of your peers. If not, please consider them. And other ideas. Brainstorm based on what you see on this slide. Could be ways to align with even another firm or pick up another skill set. Notice that these practice building ideas create potential ongoing revenues for your firm, as I discussed previously. Why is this important? Okay, under practice management, I want to talk about this. Let's refer back to the 101 slide once again. We talked about cash flows, okay, the C. What about risk? How do you quantify risk in your practice? Now, I want to take you away from thinking like an attorney for a moment. Let's say you are an investor in law firms. You like to buy them. It's your area of expertise. If you're looking at two practices with identical cash flows, which one do you want to buy from a risk standpoint? The one that has steady repeating work or the one that has non-recurring work? Cash flows and profits are identical. It's not a trick question. Of course, the first one. Why is that? Steady repeat profits drive down business risk, not just in law practices. Buyers usually pay a higher price for this. Now, I'm not telling you how to run your practices. You just need to consider this when you're thinking about the overall firm and your individual book of business. Many of the engagements on the left side, including actually all three here, can be constructed as profitable recurring work if done thoughtfully and creatively, which should drive down your business risk because of the recurring cash flows. The engagements in the ouch section could also often be profitable. And again, I'm not telling you how to run your practice, but just consider an issue for discussion. The ouch section ones are less likely to be repeat engagements, but they may require specialty expertise that not every attorney has. Specialty work may have the advantage of lower marketing costs if you become the go-to for bankruptcy, family law, shareholder disputes, personal injury, etc. The difficulty arises in projecting future income on specialty practices, especially when one person is the rainmaker. Will the income continue? Can the goodwill be transferred to the next generation of partners? Remember, value is based on future cash flows. Let's press on the future cash flows issue a bit more. Consider how many baby boomer clients you have and could lose future revenues on without a proactive approach. So if I walked in your practice today as a potential buyer, is there a risk that some of those clients, the cash flows from those clients, will not continue on without a proactive approach? And what kind of risk does that put your practice in? Or you can proactively attack that, putting your practice in a better position. Now, I think sometimes the conventional wisdom is, possibly, I've heard this, is that if you lead your baby boomer or business clients and such in the direction of a sale or succession plan detailed, you might lose that client. And yes, that is a risk. But consider the alternative, which is that things just blow up very suddenly without a plan. With some careful planning, you may be able to retain the new client, the new buyer. Could be a family member, could be somebody totally outside the family. Now let's talk about business valuations and risk. We talked about recurring and non-recurring revenues for your practice, making money. Now let's talk about staying safe a little bit. As you move from left to right, going without a business valuation also gets a lot riskier. In some cases, they'll be specifically required by a regulatory body. The IRS, the Department of Labor, the Small Business Administration, the Securities Exchange Commission. In others, they aren't, but maybe you don't want to go into a courtroom unprepared when your entire case hinges on business value, damages, or other monetary issues. Or maybe you want to protect yourself from a mergers and acquisitions assignment from blowing up after the deal is done, which we're going to talk a little later about how just tweaking a couple of things can move the value of a business substantially. So can it be possible that you can advise your clients in some of these areas without a business valuation, some outside expertise, what have you? Of course, yes, it can happen. It does happen. However, there are some things that can be a little more risky, particularly when you're dealing with the Internal Revenue Service or you're going into court. Dealing with the regulatory bodies is certainly an area where generally it's required by law. So keep those always in mind. To sum up this slide, we've established that most of you see one or more service areas on the slide that you're involved in. We've established ways to add more cash flows to your practice by utilizing valuation of what you're doing and being a hero for your clients. We've talked about risk in your practice. One element of risk is a practice that has recurring work versus one that has non-recurring, possibly specialty work. We've talked about whether certain services are riskier to you and your clients without a business valuation. As you move right, risk without a valuation may increase. Give you a couple other practice building ideas. I don't know if any of you have some older C corporations that you're advising that would like to take a look at an SCorp Election. It's a big decision. It's one that can have some tax ramifications. Again, this is one where I have seen practitioners go without a business valuation. That could be a mistake, could end up costing your clients a lot of money in the overall big picture. So keep that in mind. One that is not specifically listed on here is some clients that have some personal goodwill in their business, and it may be advantageous to have the business valued so you can carve out some of that goodwill and set it aside for capital gains treatment upon sale. So keep those in mind. Those can be hero engagements where you can save your clients tons of money with some proper planning. You have to weigh the cost benefit of it. Regarding practice development, please keep this quote in mind. This is the law firm trend power quote I put in this presentation because I think it's very important. This comes from the Georgetown Law Report on the State of the Legal Market, which I referred to previously. It's a great read. It's a pretty short read, and it has a lot of graphs and charts, so it makes it even a little quicker to get through. And if you haven't had a chance to take a look at it, I highly recommend you do that. I've linked to it in this presentation. There is now strong evidence that the U.S. legal market has segmented into discernible categories of highly successful and less successful firms, and that the performance gaps between those categories has been steadily widening. This is not intended to scare you. However, we all need a little motivation sometimes to build growing and long-lasting businesses. I have faith that all of you can do this. Once you decide which one you are, and if you are not content, make an action plan. Focused on being a problem solver for your clients, as I mentioned in the opening. With a focus, I think honestly, on business value and driving business value, you can transform your practice. Let's take one quick look at the link in this slide for the Georgetown Law Report on the State of the Legal Market. This is what it looks like. 19 total pages. I think in actual reading amount it's shorter. It's 17 pages in reading. and it has a lot of good information in it. So I highly recommend you take a look at it. It goes into a lot of detail about your industry and the various areas, metrics used to monitor it. So give it a read. Who should you use to prepare a business valuation? Or more importantly, who is the real deal and who is a pretender? At the top is a great quote. If you don't know where you're going, any road will get you there. So I believe it helps to have standards. Standards in how you're going to work through an assignment and conduct it for the client to protect them, to protect us as professional advisors. I am biased toward the top two organizations because I'm a member of those two, the AICPA and the NACVA. Most of you are probably familiar with the AICPA, over 400,000 members. The NACVA has been in the business valuation profession longer than the AICPA, founded by a group of CPAs that decided that business valuation needed its own group to prepare business valuations and have a set of standards and do it the right way. That was the first organization that I became a member of as a valuation analyst. And all 5 of these organizations have unified standards. That, I think, is very important too. These organizations have come together as a group to decide on a unified set of standards for their clients and for their reporting. And it leaves less to the imagination for preparing a quality work product. I don't know any outside the CPA realm that have the deep and wide experience in accounting and finance, professional standards, training, ongoing continuing professional education, mentoring, authors, thought leaders, and many other attributes that aid in a good work product. If they're out there, they could be. I'm just not aware of them. The IBA has been acquired by NACVA, so you could say I'm affiliated with 3 of the 5 above in some way, shape, or form. I'm an ABV under the AICPA, and I'm a CVA under the NACVA. I'm not Canadian, so that really only leaves the ASA that doesn't touch me in one way or another. The ASA is a great organization, and I know some ASAs as well. Why does this matter? Would you prefer working with someone aligned with an organization governed by high standards? Or would you prefer someone who just wings it? That's really the issue here. And if you're going into a courtroom setting, litigation environment, up against the IRS, a regulatory body, or even just consulting with someone on a buy or sell of a business, it helps to have standards, to have something to follow, and continuing training. Now, what do I mean by standards? Here are NACVA's general and ethical standards: integrity and objectivity, professional competence, due professional care, understandings and client communications, planning and supervision, sufficient relevant data, and confidentiality. Those are the high points I hit here on this slide. There's a few other things, but these are the primary. You would think everyone would follow these automatically when preparing a report. However, some people don't. And certainly those that aren't aligned with any organizations probably would never do that. I like to think most of my colleagues within NACVA and AICPA follow professional standards, general and ethical, to get a quality work product to you, the professional attorney, and your clients. You may be surprised to know that some will rig a valuation report to get the answer the attorney asks for. And I say that sarcastically. Yes, it does happen. I don't think it happens a lot, but it does happen. You may be surprised to know that someone would come up with a wildly different value if they were working for one side as opposed to the other. Yeah, that happens too. Again, I don't think it happens a lot. It does happen. These standards are designed to prevent those problems and many others. We should get the same answer no matter which side we're on. So I should not be influenced by who has hired me. I should work hard to get a result that I can support and back up by the data and my judgment. One of the metaphors I threw in here and asked you to use when you're talking to an expert or engaging someone to help you with this is kick the tires. Now, what do I mean by kick the tires? Ask the expert helping you, what are your professional standards? That's going to be a big, important, the answer to that question is going to be huge. What organization or organizations are you aligned with? How do you conduct your engagements? These are questions you should ask your expert. What data sources do you use? How often do you attend continuing professional education? Do you have a review or mentoring process? Now let's take a look at some of these in a little more detail, just so you get a sense of what we're talking about here. These are NACVA's general and ethical standards. Under integrity and objectivity, shall not knowingly misrepresent facts. That sounds pretty important. Must not act in a manner that is misleading or fraudulent. Yes, very important. Professional competence, and this is important. You can take an engagement if you lack experience or knowledge. However, you must take steps necessary to gain the expertise through additional research, consultation with other professionals. Makes sense? This is something that comes up all the time. Do professional care. Exercise due professional care in the performance of services, including sufficient research and obtaining adequate documentation. So while this would not preclude using a rule of thumb, as we're going to talk about later in an engagement, it would certainly be difficult to issue a report where the rule of thumb was the entire evaluation and comply with this standard, in my opinion. So you're going to have to do more than that, more than just a rule of thumb out of a rule of thumb book, which is not going to be sufficient data. Could it be in the report as a supporting measure? You bet. And how about understandings and communications with clients, written or oral, on the nature, scope, and limitations of services? If a significant change is required, you'll notify the client. Inform the client of conflicts of interest, significant reservations concerning the scope or benefits of the engagement, and significant engagement findings or events. Very important. There will be times when the expert will be prevented from obtaining all the information he or she wants to complete the engagement. At that point, a decision needs to be made. Go ahead with it without all the information, which often happens, with that communication occurring with the client and you, the attorney expert, or continue to push for more information so that scope limitation isn't there. Planning and supervision, pretty self-explanatory. Sufficient relevant data. Confidentiality makes total sense. Not disclose any confidential client information to a third party without first obtaining the express consent of the client. So I wanted to go through these standards so you're aware of organizations that have standards, what the common standards are, and what questions you should ask your expert to protect yourself and your client. This is what the valuation analyst needs from you to complete a report. The purpose of the valuation, the date of the valuation, the percentage of interest valued, the standard of value, and the premise of value. Now, the analyst will need more than this from you and your client, whoever's gathering the data, but these are minimums. You absolutely have to have these nailed down when you're doing a business valuation. Most of us are not attorneys, including myself, so please don't ask us to interpret the law. These will largely be determined by what body we are reporting to. Could be a court. Which one? Which state? Could be the IRS, the Department of Labor, or some other regulatory body. So you'll be the expert on these areas, and you'll have to communicate this to the analyst if you have a valuation or similar associated report. The standard of value is an area where some get hung up. Again, it must come from you. There's typically legal language that you, the attorney, must research to guide us, the valuation analyst, on how we are going to value a business, provide damage calculations, interpret income, etc. Please don't ask us to guess on this. It could doom an engagement from the start, so you don't want to get off on the wrong foot. Many times the standard of value will help determine whether we should apply discounts to the value as well as adjust the cash flows. So those are a couple of areas where the standard of value may decide which way we go with certain decision points. Goodwill is another area where we're going to have to be in communication with you on the standard of value and the jurisdiction we're operating in and what the rules are. So we need to know the rules we're playing with before we start the game, so to speak, to give you an analogy. The premise of value is typically one of two paths: liquidation or going concern. In other words, the premise that the business will be liquidated or continue operating as a business. If it's a bankruptcy, the premise may be liquidation. If it's a divorce, the premise may be going concern. That is, it's going to continue to operate as a business and collect cash flow. The business valuation with the $131,000 difference. Two valuations 6 figures apart. Why would that be? This is a small business with a 6-figure difference. I promised only 2 math slides. This is number 2. We're going to walk through an example. The assumption is that there are 2 valuation reports on a business with only $500,000 in revenues or sales. Probably not a big business in your area. Not in mine either. Certainly not in a larger metropolitan area. We are only going to change 4 variables and take a look at the results. They may surprise you. Now let's set the stage with the assumptions. We're going to say that the purpose was for divorce and the standard of value in whatever jurisdiction you're in. 100% in controlling interest. Premise of value is a going concern. The date of the valuation is December 31st, 2016. It is an S corporation. Both analysts use identical tax returns, and only analyst 2 is going to make direct cash flow adjustments to the tax return. And what I mean by that is analyst number 1 is going to accept the data from the tax returns as is. Analyst number 2 is going to dig in and find a couple of things that he or she thinks are necessary to change to adjust the cash flows, given that it's a controlling interest, 100%, and the standard of value allows that in the jurisdiction for divorce that you're in. Again, they're assumptions. I'm not going to specify the state we're in. We're going to keep it pretty simple. We're going to change 4 variables. Personal expenses are going to be removed for valuation analyst number 2. Depreciation and the associated capital expenditures are going to be lower for valuation 2. Income tax rate is going to be lower for valuation 2. And the discount or risk rate is going to be lower for valuation 2. Remember the 101 slide. Remember cash flows, risk, and growth. We're going to hit all these here. We're going to hit them quick. And we're going to show what impact 4 variable changes have on this. Now let's take a look at this and see what happens. These tabs in the spreadsheet are laid out very simply. Historical income statement. We're going to make some adjustments to get to valuations 1 and 2. Then we're going to calculate the capitalization of earnings method, and then finally the actual value. So we're going to analyze the income stream in these 2 tabs here, and then we're going to get a value. So we're going to keep it simple. $500,000 business. These are the historical tax returns, unadjusted $10,000 in net income. Analyst number 1 makes no adjustments. Analyst number 2 makes one $10,000 adjustment. He or she believes and substantiates in their work papers that they find $10,000 of personal expenses in the cash flows that they remove. So the results are that the adjusted valuation net income is $20,000 for valuation 2. It's $10,000 for valuation 1. Nothing changed in V1. $10,000 more income in V2. Makes sense? The one $10,000 change. Now the inputs for valuation 1. Same for both. Depreciation, state income tax, federal income tax, working capital, capital expenditures. Valuation analyst 2 elects to use lower depreciation and a lower federal income tax rate. And that could be the case in the event that the company being valued is an S corporation, and it is expected to remain an S corporation if it is bought, or whatever's going on in the particular fact pattern. There are some times tax benefits associated with S corporation shareholder distributions that result in a lower effective income tax rate overall. Sometimes. That is going to be the assumption here. What happens? Valuation 1 results in $23,000 of cash flows after we make the various adjustments to net income for taxes, working capital, capital expenditures. Analyst 1 ends up with cash flows that are 5% of our $500,000 sales. So $23,000 is 5% of the $500,000. Analyst number 2's cash flows are $39,000, resulting in a cash flow difference from 1 to 2 between those two of $16,000 or 70%. However, notice that valuation 2 cash flows are still only 8% of the revenues or sales. So it's not exactly knocking the cover off the baseball here. It's a profitable business, but not hugely profitable. Still single digits in cash flows. Analyst number 1 elects to use a higher discount rate of 20%, a risk rate. Again, the 101 slide. As we discussed, analyst number 1 uses lower cash flows because of fewer adjustments, really no adjustments, higher income tax rate, higher depreciation. That results in an estimated value for analyst 1 of $152,000 for this business. Okay? The second one, analyst number 2 elects to use a lower discount rate after judging all the various factors, management, financial strength, looking at the cost of capital data, many factors. So he or she elects to go with 18.5% with higher cash flows adjusted to a capitalization rate of just under 14%, results in an estimated value under valuation 2 of $283,000, a difference of $131,000 or 86%. What do you notice about this? Anything jump out at you besides the six-figure difference? First of all, to reiterate, this is a small business, $500,000 of revenues. Think about this difference if you had a $1 million sales company or even a $5 million in sales company. Only 4 variables move the value 6 figures. Another thing I want to point out, cash flows in the income tax rate account for a much larger portion of the difference than the discount or risk rate change. You can see $94,000 of the $131,000, or almost 72%, was related to the adjustments made to the cash flows, as well as the decision on the income tax rate, which also ultimately affects cash flows. Using our metaphor of kicking the tires again, cash flows are going to require more tire kicking and judgment than most of the other areas in evaluation. This is where the time needs to be spent. Yes, the discount or risk rate is important. However, there's a lot of data within the cost of capital guides, such as Duff and Phelps, to be able to narrow your discount rate into a pretty supportable range that, again, won't move the valuation too much unless somebody is way out in left field. Now, ultimately, it's going to be judgment. But again, the belief of most analysts are that you need to spend time on the cash flows. Now let's push on that a little further. You are handed a tax return or a financial statement, and that tax return or financial statement will be the basis for your case or position you take. Are you going to accept that tax return or financial statement without corroborating evidence? I ask that you consider not doing that anymore, as supported by this example. There's too much at stake. Trust but verify is the maxim I would use when you're in these situations. And if you don't understand the financial data, and that's okay, there's no shame in that, please get someone to help you. I'm going to mention a few other examples of things I've seen. You may have seen worse. You may have seen the same types of things. I've seen big businesses with sketchy records and small businesses with good records. I've seen accountants and bankers collude to produce financial statements, misrepresenting a business. I've seen money hidden from family, from the IRS and others. I've seen income go unreported in multiple industries. I've seen personal expenses as high as 6 figures run through a business by the taxpayers. I've seen an elderly married couple freely admit, under confidence, that they've been underreporting income to everyone, including the IRS, for years. So you can't judge a book by its cover, as is often the case. I've seen professional service firms in multiple areas of discipline lie to keep clients so that fees keep coming in. Manipulated data so that they can keep everyone happy and keep the client. All this said, I generally give anyone the benefit of the doubt going into a situation. I'm going to drive this point home a little further with a story. When does a valuation engagement also become a forensic engagement? This is a true story. I'll leave the names out to protect the innocent. And nothing is necessarily wrong with how this turned out. I don't really know if there was a problem or not. That's why it bothers me to this day. An attorney called me to meet on a case where they were considering a business valuation. It was a divorce case. The attorney represented the outspouse. They showed me a jointly filed income tax return with a Schedule C business. The business showed a loss, and the return generated an earned income tax credit of a few $1,000s. Now, for anyone watching the presentation doesn't know what the earned income tax credit is, the short answer is that it's a subsidy. It's not a return of tax paid. It's a program within the Internal Revenue Code designed to put money in the pockets of those that didn't earn enough money in a given year. Business was all cash, and the tax returns didn't reflect that. The business transported vehicles between auctions where payments were made in cash only. The outspouse had been on these trips many times and seemed confident the business was profitable. Very profitable, in fact. The trips often yielded $1,500, a couple $1,000 per trip. She also said they had a nice home, cars, and then she and her attorney showed me pictures of various toys. Toys as in motorcycles and things of that nature her husband purchased. Keep in mind, I didn't know if the outspouse was telling the truth, of course. However, at that point, I had no reason to think that further investigation wasn't warranted. I recommended reconstructing the income using forensic principles or means testing and then valuing the business. 2 separate engagements, ideally conducted by 2 separate experts. That's the generally accepted practice. I could have assisted with either. Within days, I called to determine the status of the case, and the attorney told me they had settled the case. I don't know what happened between our meeting and the settlement. Maybe some work was done to verify income or value or both. It has always bothered me that I never found out whether income was concealed or the out spouse received an equitable settlement, assuming income was concealed. My question to you is, if you were in a similar situation, what would you do? Would you hire an expert or would you go alone? Based on the six-figure difference I showed you on a small business earlier, the $500,000 business, would you feel comfortable going alone? My gut told me the business in the story was likely a six-figure business. It wouldn't take long to get there at $2,000 a trip. What if you had reason to believe it was a seven-figure business? Ultimately, you must decide what's in the best interest of your client and your practice. Another thing, again, I'm not trying to make a cynical comment, but a small business is a perfect way to conceal income. There are a lot of ways that you can do it if you know how and if you're clever and devious enough. So keep that in mind anytime a small business is involved, certainly a business that takes in cash. You need to have your eyes open to the possibility that what you're seeing does not reflect reality. Rules of thumb, a tragic story. How many of you have used rules of thumb to value a business? Were you comfortable with that approach? Did you have confidence you nailed the value of the business? Let's go through a quick example to show how rules of thumb can be a little dangerous. I'm using the data that we took a look at earlier from our two valuations from two different analysts. A common rule of thumb indicator is EBITDA, earnings before interest, taxes, depreciation, and amortization. So what I've done here is I've used an EBITDA of 3 or 4 for valuations 2 at the top and valuation 1 at the bottom. So column A is a multiple of 3, column B is a multiple of 4, and then valuation 2 is at the top, valuation 1 is at the bottom. Now notice that when you use the rule of thumb factors, you're potentially off a 5-figure difference in every scenario except for V2 and a multiple of 4. So if you were lucky enough to pick that one, 4, and use the right base, you got close enough probably. Otherwise, you missed the mark a lot. So keep that in mind. These are big differences, and oftentimes the factor is usually a whole number or something. There usually aren't any decimals or half points. I've always found it interesting that someone would work their whole life to build their company and then value it using a rule of thumb. I've found that to be really tragic, and that's part of the reason why I use the Shakespeare reference here. It's really kind of sad that someone wouldn't want to get a little more precise with it, and how much money people leave on the table by doing that. So I joke here, whose thumb are you going to use? And as I pointed out earlier, what base are you going to use? The cash flow base. And do you know it's grounded in reality? Have you verified that base? Is it realistic? Have you taken a look at all the various factors, as we spoke of earlier, that affect your ultimate cash flows? Another thing that I want to point out is I've been valuing businesses for a while, and I've never seen two that are exactly alike. Implicit in using a rule of thumb is this idea that if you're in the same industry, that every business is alike, and they're not. None of them are alike. If I could distill it down to one factor that separates the successful from the less successful, it's usually management is the most critical factor. There are a number of factors that go into it, but you could have two identical businesses in terms of employees and size of revenues, but one could be much more profitable because the management is so much better and their business model is so much better. So keep that in mind too. The rule of thumb is largely based on hearsay. It's out of a book. It's something that people in the business have used for years, and businesses are bought and sold on rule of thumbs. That doesn't mean it's a good thing to do. Again, the differences, think about the differences. 5 figures on a $500,000 business could be 6, 7 figures on larger businesses. And there is some real malpractice risk here. So keep that in mind too. If someone comes back to you after the fact and tries to push this with somebody using someone that analyzes this in greater detail, it could cause some adverse consequences to you or your team. So keep that in mind. I don't want you to get in trouble here. How do you know if you need a business valuation? So it's a decision you need to make in certain cases. So I've laid out some things here to help you as much as I can. I believe if you're dealing with a 6-figure and above business, at a minimum you need a consultation and a calculation. That calculation at the preliminary steps would not be something that could be brought into court. Maybe the expert would be brought in on a consultative basis to see if it meets the cost-benefit need for your case. Be skeptical of all financial data you're getting, even from CPAs. If you have suspicion that there is concealed or manipulated income with the business or income stream, it should cause you to want to figure out what the real income is so you can decide what the next steps for you and your client will be. Please talk to an analyst early, and again, run a cost-benefit analysis. He or she can help you with that. I personally spend a lot of time on the front end before I charge anything in my particular cases because I want to find out if I can help you and the client. If it looks like I can be a benefit, then I'll make a recommendation and a proposal. If I can't, I'll tell you that. That's my approach. I can't speak for everyone else. Anytime a regulatory body requires a business valuation, you need one. And anytime you think you could end up in court, which could be a lot, unfortunately, if there are emotions and deep pockets involved on either side. How much does a business valuation cost? It depends. I've listed some factors here that will have a huge impact on the cost. It could be anything from a quick consultation to a multi-month or multi-year scenario. So that will have a huge impact on the cost. Factors include whether or not it's going to court, good records or poor records. Are the cash flows predictable or are they up and down? If the analyst has to create a future discounted cash flow stream, that's going to take a lot more time and effort. Is there forensic work needed? We pointed out earlier. Is there unreported income? Is there a need to do investigative work to determine what the real income stream is? Is it a minority interest or a controlling interest? Unfortunately, typically the minority interest is going to involve some more time because discounts may be involved and there are different levels of adjustments that may need to be made. Discounts is the next area. They can come into play in certain areas, certain cases. The biggest discounts typically are control discounts, lack of control discounts, or marketability discounts. So in other words, if a person holding shares in a business lacks control, that is one level of discount, reduction in their value, potentially. And if their interest is non-marketable, there is another potential level of discount. There are other discounts, but those are the two most common. Whether or not the analyst will have access to management or not, big factor. If the analyst has to make a lot of judgments, do some research that would normally be provided with direct access to management by going around the management, such as in a litigation or divorce case, it could potentially add to the cost. Quick answers on questions or drip drip. It's going to depend a lot on how many times someone has to pick up the case and set it back down. And is it due now or is there some time? Again, get the analyst involved early if you can, please. That's one of my biggest recommendations. And overall, I'd ask the better question, what's at stake? And again, go back to the cost-benefit analysis with someone on the front end and decide what's at stake 5 figures, 6 figures, 7 figures, and what your client stands to lose if it's shortcutted. I will try to give you a range here as best I can. It's a big range, but I'm doing the best I can with it. On the high end, I see a situation where you have a multi-month or even multi-year ongoing case, and it will be difficult to bill it any way other than by the hour. It could easily be 6 figures, even 7 figures. I've heard of other colleagues I have that have been involved in Ponzi investigation schemes and such, over $1 million in fees. Way at the other end, a consultation with an expert doing some calculation work on the front end that would not be brought into court for a case is something that could potentially be done in the $1,000 range. In between, there could be projects that could be 4 figures or 5 figures, depending on what the case is. I personally try to price certain projects to the extent I can if I know that it's within a defined parameter and I know what I'm working with. I won't speak for other analysts. That's what I will try to do if at all possible. So they give you some ideas for cost. Not perfect, certainly, but that's the best I can do at this point. We're talking about a range of different types of areas of assistance in a range of different circumstances. Let's wrap up, and please call me or email me with any questions you have. You now can explain business valuation basics. We went through one of the math slides you may recall. V equals C divided by R minus G. Value equals cash flows divided by risk minus growth. You know how to use basics for your clients and help them. You know how you can build your practice using business valuation basics. Remember building recurring income streams for your practice. Remember, if you do not have a practice structured for recurring income streams, that it might be a good idea to become the go-to and an expert in an area. Know when you need help in valuation areas. Determining income streams, damages, forensic work. Know who can help you on valuation. Who has the credentials? What are those organizations? The standards involved. Please remember that skepticism is your best friend in these cases. If you are in a case with a business of any kind, walk into it being skeptical of the documents that you have in front of you may not reflect reality. So please remember that. And know that small business is big risk. Here are the sources I use for this presentation. We talked about the Georgetown Law 2016 report on the state of the legal market. Please read it, and I hope it will help you build your valuable practice. Know areas that you can work on after reading that. Course material from NACVA and their current update and valuations, and professional standards from NACVA, NACVA, the National Association of Certified Valuators and Analysts. Here's my contact information. Please take that down if you need anything at all, or refer back to this presentation if you need me. I've had a lot of fun with this. I really enjoy talking about this and helping you. I hope someday we can speak or meet in person and we can work on a project together. But if not, I think you have some valuable information here you can use to help your clients and your practices. This is Josh Horn, CPA, signing off. Have a great day and best of luck with your practice. Bye-bye.